What is working capital? What is working capital? Why does it matter? And how can you improve it for your business? Let's dive into this complete guide. Working capital. Example: the specialty coffee shop. Let's imagine you operate a buy, stock, sell business in specialty coffee. You buy premium beans from your supplier, hold them in stock, then sell drinks and packaged goods to customers. Sometimes the product moves through your business at a nice, steady pace. Other times, things slow down a bit. Now, what would you prefer as a business owner, assuming the pricing and profit margins are the same in both situations? Would you choose option A? You pay your supplier cash on delivery, hold high inventory levels, and allow customers 45 days to pay? Or option B, you get 45 days of credit from your supplier, keep a just-in-time inventory, and your customers pay cash on delivery? Think about that and vote. With option A, you have high working capital, which needs to be financed with debt or equity. With option B, you have low working capital, reducing your need for financing. That means cash flow and return on assets will be lower in option A and higher in option B. Working capital defined. Working capital, often called net working capital, NWC, measures the difference between what your business owns and what it owes in the short term. It's a key indicator of whether you can meet your short-term obligations and keep daily operations running smoothly. The definition we'll use in this video is: working capital is the total amount of capital invested into your company's operating cycle. This view gives the most practical insight into how your business functions day to day. Working capital and cash. So what's the relationship between working capital and cash? Let's say your coffee shop starts paying suppliers faster, increases inventory, and allows customers more time to pay. This will increase your working capital, but reduce your cash, possibly pushing you to seek financing. Now imagine the opposite. You delay supplier payments, turn over inventory faster, and improve customer collections. That would reduce your working capital and increase your cash, freeing you up to pay down loans or distribute dividends. Working capital formula. There are two key ways to measure working capital. Working capital equals current assets minus current liabilities. Current ratio equals current assets divided by current liabilities. Current assets include accounts receivable, savings, inventory, and short-term investments. Current liabilities include accounts payable, taxes, rent, and salaries. Working capital case study, 3M. Let's look at a real-life example using 3M's balance sheet from December 2018. They reported $5 billion in accounts receivable, $4.4 billion in inventories, $2.3 billion in accounts payable. That results in a net working capital of $7.1 billion. Some might also consider other items like prepaid expenses or accrued payroll, depending on context. Working capital case study. Microsoft. Now let's look at Microsoft's balance sheet at the end of June 2018. Just like 3M, we examine accounts receivable, inventories, and accounts payable. But Microsoft has one more factor: unearned revenue, also called deferred revenue. This is money Microsoft has already collected for services it hasn't yet delivered, making it a liability. When you include unearned revenue, Microsoft's net working capital is actually negative $12.1 billion. And that's a good thing. Why? Because both suppliers and customers are financing the company's daily operations. How much working capital should you have? Working capital levels vary by industry. Retailers like grocery stores often have low or negative WC because they sell products quickly, often before even paying the supplier. On the flip side, companies with large inventories typically need higher WC to stay afloat. But don't forget, too much working capital can be a red flag for investors. It may signal that you're not using your resources efficiently. Do you need more working capital? Here are a few reasons your business might need more working capital. Preparing for emergencies like a recession or legal issue. Attracting potential investors who want to see liquidity. Applying for surety bonds or performance bonds. Managing short-term debt and operational costs. How to improve your working capital. If your company's WC is falling short, consider these tactics. Pay your debts on time to avoid late fees. Cut unnecessary expenses. Improve accounts receivable. Offer incentives for early payment. Consider a short-term working capital loan if needed. As management, it's your job to monitor WC. It doesn't just affect cash flow, it affects your ability to grow or stay lean in tough times. In summary, working capital is the capital that keeps your business running daily. Manage it well to improve your company's cash flow, boost efficiency, and increase returns on assets. Thank you for watching. Want to learn more about business, finance, and accounting? Subscribe to the Projectcubicle channel and let us know in the comments. How do you manage working capital in your business?